Looking at a Euro US dollar 30-minute chart, price has swung down here, retraced 62% and then fallen to 162%. Now on this day we've formed a base down here and moving into the next day of trading. We're coming down here and we're testing that base as liquidity picks up, and we come down and test the low, and we test it a couple of times within an hour. Price now starts trading and holding above this critical price level of 25.50. As long as price is trading above 25.50, we're good. And if you want to make a trade here, let's say you wanted to make a trade at the asking price of 25.60, and you entered 10 lots here. You enter 10 lots, and your first profit target is at 25.80 for 8 lots, and your next profit target is you could have it above, you could have it right around these highs, but you can have it at 2600 and below these highs, so say 2600 area. Let's say you enter with 10 lots. We can do this. We enter here with 10 lots, and as the market moves up, we take out 7 lots here, and price bounces at 25.80. You take out 7 lots at 20 pips. Then we watch for price to get to the second profit target. You take out 2 lots at 2600. Then on the final 10%, you simply take your protective stop, which would have been somewhere below this low, and you trail the market. Now, price has made an intraday high so far, and what we'll do is we'll put our Fibonacci levels on here, and you can do several things. Depending on how you want to trail the market, you can either trail it below the low, or you can trail it below the 79% retracement. You can move it above where you entered and trail it still below the 62% retracement to protect you. Price comes down, retraces to the 50% level, and starts to rally and make a new high. Once price has made a new high, it's a clearly established high at the 10-day moving average. Now you can move your protective stop, you can keep it below your 62% retracement from here. Or what you can do, let's see if that high forms. It's bouncing at the previous high now. Continuing to rally. The other thing we can do is we can take our fibs and we can just look to see where price bounced on this swing. It's bouncing at the 38 retracement. You could put it also below the 62% retracement here, now locking in. We entered at 60. We're now at 90. We've now locked in 30 pips on our last 10% as we watch the market continue to move higher. We're still moving higher. We're now 65. Our stop is now 65 pips away. And the market has made a new high. You can do any number of things. You can take your big swing like this and hold your stop behind the big swing, behind retracement levels on the big swing. Or you can move your Fibonacci swing up to this low on this swing, and right here the 38% retracement looks like a logical level for the market to bounce. And you can simply just take your stop and put it below this low here. You can put it below the 79 or the 62. If you want a real tight stop, you can put it below the 38. Now we've locked in from 60 to 30. We've locked in 70 pips on the last 10% of the trade. Watching the market consolidate into the next day of trading. Now we're making a run at the new high, at the previous day's high. It is rejected. If we move below 2660, the trade's in trouble. Now we've carried this trade for several days. We've broken through the trend line. We've tested the backside of the trend line, tried moving above the previous day's high, and it has been rejected. Now, if we get below, you see this 60 level here? That's quite an important level. It bounces at 60. Now it moves through. Now the trade is in trouble. This is our protective stop here, still at 30. And it bounces there, and we now get stopped out. So we made 70 pips, and it took a period of about 2.5 to 3 days. That was a kind of a short to medium term trade that sustained itself for about 3 days before getting stopped out.